Hey guys, today we're analyzing Celsius, an incredibly popular stock among the retail crowd, so let's take a look at it today. Over the past 5 years, incredible performance from up 6,000% basically. If you would have known that they would get this Coca-Cola deal, then you would be bankrolling right now. But yeah, of course, most people didn't know about it, obviously, until they started running up, and now everybody knows about it, it seems like. So let's take a look at the numbers. Let's see if it's a buy right now. Maybe it's a sell. Let's take a look. It is at a $21 billion market cap. Definitely grew a lot, and now it's a pretty large company. 21 billion is nothing to scoff at. Price to earnings ratio of 116, so they better have some growth because that's a very high price to earnings ratio. And yes, it does look like their growth. They do have lots of growth, and they do have a net margin in their past 4 quarters. They had positive net margin, so that is good to see, of course. Let's take a closer look. Oh, actually, so yeah. Let's take a closer look, and then what we're gonna do is later on we're going to compare Celsius to Monster because this could be a competitor of Monster, and Monster, of course, is a bigger company than Celsius. So let's check out the statements here. We are up 100% year over year for 2022 and then 2023. On a quarterly basis, we are also going up 100% each and every quarter. So that is very, very good to see as well. And it's they're spending a lot of money on cost of goods sold and operating expenses. Looks like their gross margin is going to be about 50%, and then looks like a lot of it is transferring into the bottom line, which is good to see. Checking out their balance sheet, they do have negative 753 in debt, so very good balance sheet. Cash flow is going to be pretty similar to their income. Checking out their stats on an annual basis, their net margin at 14%, 17% last year. Their gross margin at 47%. One of the companies that I really want to compare this against is Monster. So let's take a look at Monster. So, okay, my headphone cut out there for a second, but we're all good now. So Monster is a $62 billion market cap. So if Celsius wants to compete, and if you think that Celsius could becomes as big of a company as Monster, then there is a 3 times upside in Celsius. But of course, it's going to take time, so we'll have to see how long it might take for that to happen. And there's also lots of different risks, of course. There's the risk that Celsius falls out of favor with the consumer. But Monster is trading at like a 38 price to earnings ratio right now, which is also fairly steep. Not as steep as Celsius, of course, but still pretty steep. Looking at Monster's growth is pretty good. The revenue at 7.14 billion, and they have a net margin of 23%. So if Celsius can also hit that net margin of around 23%, or like maybe get their net margin up to like 25%, then that's probably what we're going to use for our discounted cash flow model later in the video. In terms of Monster's growth is about 14% or 13 to 14% every single year, and they haven't had any negative years, 0 negative quarters. So Monster's growth is very good, and it's probably has to do with the beverage market, with the caffeine, very addicting, and once people get hooked, then they keep coming back for more. So it's kind of like a drug in that way. And so that's what I wanted to look at is Monster. So let's go into their estimates, their average estimate for next year and the year after in terms of earnings, and then in terms of revenue, we're looking at 1.88 billion going up to 2.48 billion in the next year. And Monster was what, like 7 billion last year? And so they're like not even they're 3 times less, or like 3.5 times less, or 4 times. Yeah, like 4 times less in revenue. But they're growing much faster. So let's check out the DCF model. We're gonna have to change some numbers on this, but that is okay. That's the point of it. So I put in their EPS estimate and their revenue estimates, and then their growth of 40% for their earnings next year. And then the revenue growth, they're predicting 32% revenue growth. Profit margin of 20%. Is that accurate? Probably fairly accurate. Let me check really quick, going back to Celsius, what they did last quarter for their net margin. Net margin of like 14% last quarter. But I think that they could do 20% next year in profit margin, and then probably going up to 25% from there. And I think that's probably where they're going to sit, is around 25%. That's around where Monsters is. And then growth of 32%. I think that is the analyst estimate. I think that they could continue growing fairly fast, especially when you look at Monster growing at 13% every single year, and they're already a large company. So this Celsius has room to run. I would put them at like 25% growth for the year after that, and then maybe 20% growth going forward from there. And man, if they did that, then they're undervalued at this price. But maybe, yeah, that's if they can continue to grow at 20% every single year, which might be a lofty goal. Maybe they slow down to 15, and then while Celsius is still growing at 13%, Monster's still growing at 13%, so maybe 15%, and then eventually they fall down to around where Monster is at 12%. One other thing to look at is exit multiple. With an exit multiple of 20, right now Monster's trading at a 38 multiple, so I think 20 is actually too low. Probably a 30 exit multiple for Celsius. And if we do a 30 exit multiple with a discount rate of 10%, I actually think that this is probably the most likely scenario. If you guys want to try your own numbers, make sure to click the link in the description. I let people use this for free, so make sure to check that out. But yeah, I think that this is the most likely scenario for Celsius. We have a 20% profit margin next year, and then after that, going up to 25% and probably staying steady at about 25%. And then the growth stalling out to about 12% with an exit multiple of 30, just because it's the caffeine market, and I've heard good things about the product, like people keep coming back to it. So I think 12% growth, yeah, slowing down to 12%, and then an exit multiple of 30. We get a fair share price of $113, and I would say that if you bought Celsius today, you'd probably be expecting maybe like a 12%, 12, 13%. Yeah, I'd say if you bought it today, you'd probably be expecting about a 13% return moving forward. Maybe 14, 13, 14. Yeah, maybe like 14%, pretty close to 14%. Now, there are a lot of risks with this stock because consumers are fickle. They could change their minds on a whim. But from what I've seen, like I've seen Celsius all over the place, and it seems like people are adopting it fairly quickly. So I do think that it's a good stock for those reasons. I did have it, but I actually sold it at like $85 a share. I bought it at like 52 or something like that. I just didn't really think that the returns going forward justified its price at 85, but clearly it does. Of course, these growth projections have to play out, and that might not happen. So that's the risk when you're investing in a growth story. So yeah, keep that in mind, and yeah, hit that like button, and I'll see you in the next video.